Who will win the AI race? Which startups, those already public or those going public in the near term, will become the 10 baggers that you can retire on? There are so many new players to choose from, and it is a matter of time before companies like OpenAI, Perplexity, and Anthropic go public. The AI space is becoming crowded. It changes constantly, and we can only invest in so much. In my view, none of these AI startups are worth it. If you want to win, just keep it simple. Invest in the most obvious, in-your-face, guaranteed winners in AI, the hyperscalers. Welcome to the Quality Investor. The ability of AI agents and the various LLMs are moving at a rapid pace. Every new capability of these tools captivates the news and social media cycle for about a week until the next new capability is unlocked. In the tech sector, whether at the foundation labs or the AI platforms and applications, AI innovation is the sexiest place to be. And despite all the optimism or doom surrounding AI, it truly does feel like modern civilization is on the cusp of its next great leap forward. There is just one little downside from the investment perspective when it comes to the AI agents and LLMs, and that is commoditization. In my view, commoditization will ultimately make many AI businesses uninvestable. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. It will be uninvestable in the same way grocery stores or airlines or agriculture is uninvestable. Essentially, in the nearer term rather than the long term, customers will no longer see much differentiation in the models. This will make purchase decisions price sensitive. And I would argue we are starting to see some standardization between models and that they all generate similarly effective output. This is especially true for the casual users, though I'm sure power users will feel differently. Another factor affecting investability, and this is speculation, is government regulation. Not regulation like standard utilities, but regulation as in nationalization. I believe it is a question of when, not if, the government seeks to bring AI research and labs under its purview. This is a video for a different day, but see the Atomic Energy Act of 1946 and its amendment in 1954 to see how a government monopoly on AI might work. But one segment of the AI industry will provide the sort of high growth compound returns that we seek on the Quality Investor. It is the hyperscaler segment. And there are three specific hyperscalers that already dominate the market and are clearly forming a triopoly. These are Amazon AWS, Google Cloud, and Microsoft Azure. At first, it seems so obvious that this would be the case, just so easy that it is too good to be true. We like to believe that investing should be hard in order to generate far above market returns. But it really is this easy. I will break down what the hyperscalers actually provide, why their moats are near unassailable, and then look at what their valuation summaries tell us. The hyperscalers provide the total and absolute foundation that runs AI, physical infrastructure. And it is not a question of will they dominate, but it is how much each of their share will be. Let me show you a comparison of cloud provider market share between Q4 2020 and Q4 2025. So this is what the market share looked like in Q4 2020. That's over 5 years ago now. So we have AWS, Azure, and Google Cloud, the top three over 5 years ago. AWS leads at 32%, followed by Azure at 20%, and then Google at 9%. Coming up the rear here, we have Alibaba Cloud, 6%, IBM Cloud at 5%, Salesforce at 3%, Tencent Cloud at 2%, Oracle at 2%. So 5 years ago, Amazon was absolutely dominating at the time. But a lot of people were questioning where Google Cloud was going. It was not profitable at this time. And Azure has just been here kind of chugging along. But have the others been able to catch up and eat into this share? So the top three combined here, 32%, 20%, and 9%, that's 61% 3% of total market share. Another thing to look at, by the way, is their fiscal year 2020 cloud infrastructure service revenue, $129 billion. That's for the fiscal year of 2020. Okay, so now we're looking at Q4 2025. The first thing to notice, cloud infrastructure service revenues in Q4, not the full year, the Q4 of 2025, $119 billion. All of 2020 was $130 billion. And just Q4 was $119 billion. That's almost $480 billion annual run rate. And that was up 30% year over year. But the big three, AWS, Azure, and Google Cloud, remain steadfastly in the top three. Now, Amazon, they've actually gone down 4%. But who took their share? It wasn't any of the little players down here. It was pretty much Google Cloud and then a little bit to Azure. Google Cloud is up 14% now, up 5% from 2020. Azure only up 1% from 2020. But Google Cloud here is the one that's accelerating the most. And we've seen that in their earnings over the last few quarters. But even with Google's massive acceleration that we've been seeing, they're still half the size of what AWS is. But notice the rest of the players. Alibaba Cloud, down 2% in market share. Salesforce was down 1% in market share. IBM Cloud, down 3% in total market share. Tencent is no longer on the list. They've been replaced by Huawei. And then Oracle has actually grown their market share a little bit, up to 3% from 2%. But this total share now is 63%. So the big three have grown their total share from 61% to 63%. Google is the player here that's accelerating the most, and cloud infrastructure revenue has exploded. And that matters greatly because of that $480 billion annual run rate, 2/3 of it is going to these three players. Microsoft, Google, and Amazon have been building data centers for decades. This is hundreds of billions of dollars procured into fiber cooling systems, custom silicon, and real estate in every major geography on Earth. This has basically made them the landlords of compute and storage. OpenAI and Anthropic, as well as all the other models, do not own the infrastructure they run on. They must pay their rent to these hyperscalers. But where these big three really have an unassailable moat is in their ultra-high barriers to entry. The capital commitments required for these data centers, the land permits, the power agreements, the cooling, and most importantly, the NVIDIA H100s and B200s are flat out insurmountable. Even the most ambitious startup can never hope to attain the capital as well as hardware supply chain logistics necessary to replicate what the hyperscalers have done over decades. And by the time they do, AI will probably be evolved into something else entirely. The capital aspect is key here. Microsoft, Google, and Amazon simply print an absurd amount of money. Each of them have become cash-generating machines that can sustain multi-year, multi-$100 billion infrastructure build-outs. Microsoft projects upwards of $120 million in CapEx. Google projects over $180 billion. And Amazon projects a jaw-dropping $200 billion in CapEx. Exactly 0 businesses earn annual operating income over $200 billion. In fact, only 4 businesses earn over $100 billion in operating income. Microsoft, Apple, NVIDIA, and Google. Amazon, by the way, has $80 billion in operating income. And since they are building the infrastructure, this is where the customers will go. This leads to more revenue, which then funds their infrastructure. It is a capital flywheel. This reinforces another aspect that gives these hyperscalers a massive economic advantage: scalability. The decades of build out also means they have created a network that connects the internet. It is the road system that carries internet traffic, and they own this network. Amazon has actually built a private network to bypass the public internet for inter-region traffic. This matters greatly for AI. AI is bandwidth intensive. Training for large models is distributed across clusters. The work is split over thousands of GPUs that are all networked together. The data centers are shuffling terabytes of data over this network at lightning speed. Inference, or using AI after it's trained, requires low latency connections to end users. As customers, we want our chatbots to give us answers right away. That's why data centers are located all over the globe, so it feels fast regardless of location. Since the hyperscalers own all of this networking, they have a structural cost advantage over those that must rent compute. There is one last part of this unassailable economic moat that the hyperscalers have built, and that is distribution. Aside from their data centers being used to train AI and handle inference, they're also data repositories. Most of the S&P 500 runs workloads on either AWS, GCP, or Azure. This includes AR systems, financials, customer data, and much more, including proprietary models. The more data you store somewhere, the more applications that get built around it. Then it costs more to move it. This is lock-in, but also a huge advantage for the hyperscalers in distributing their own AI models. All Google has to tell its customers is, hey, your data is already on GCP. Just turn on Gemini. You can build all your workflows with us. It is an extremely easy sell. The market is ready-made for the hyperscalers. The hyperscalers have built the infrastructure that AI runs on. They own the compute, the storage, the networking, and each has their own proprietary data sets that they can feed their own AI models. Their scale is unmatched. Now, they can simply collect the data and AI rents from everyone else, and it will compound for years. The question now is how much of the total market will these three control? It is already an effective triopoly since they control 63% of the market between themselves. And as their infrastructure grows, so too will their market share. However, what is actually a reasonable price for these businesses in the market? Let's find out. So let's start with Microsoft here. They have three primary revenue segments: productivity and business processes, intelligent cloud, and more personal computing. Intelligent cloud is where Azure lives. And if you look at my growth rates projected over the next 10 years, my bear projection rate there is 15.8%, base is at 17.7%, and bull is at 19.65%. Productivity in business, I have at 7%, the bull at 10.9%. More personal computing is sort of a drag for Microsoft. They're having a lot of issues at Xbox right now. In fact, I think in the last earnings, their Xbox segment was down for the year. But either way, this is a very slow growth area. I heard that they're in development for the next gen console to be released in 2027. We'll see what goes on there, but I'm not projecting a lot of growth here in this segment. Overall, I have revenue growing for Microsoft at 10.4%. On the bear case, up to 14.1% for the bull case. And one of the reasons they have been falling in the market recently, aside from the whole SaaS crash in general, is there's a lot of questions around OpenAI, particularly as it pertains to Microsoft's RPO, or remaining performance obligation. About 40% of that is supposed to come from OpenAI, and there are questions lingering in the market on whether or not OpenAI will be solvent by mid-2027. Now, I fully believe that OpenAI is not going anywhere, but nonetheless, they have been a drag, and they have been getting criticized quite a bit for Copilot. But let me pose a question here. In the next 5 years, number one, do we believe that Microsoft is going to figure out AI? I 100% believe that they will. And number two, in 5 years, will Microsoft be a much larger business, especially in cloud compute, than they are today? And I think the answer there is also a resounding yes. So moving on to the operating margin, I'm projecting by year 10 an operating margin of 48% on the bear case, up to 54% on the bull case. Free cash flow margin, which by the way in a trailing 12 basis here is at 25.3%, which is down quite a bit from what it normally is for Microsoft due to the massive CapEx spending. Okay, but I'm projecting that at 22.7% on the bear case, essentially a case where a lot of the AI spending doesn't work, up to 43.8% on the bull case. Personally, I believe the CapEx spending for Microsoft and all three hyperscalers are going to work out very well for each of these businesses. And that would give me free cash flow growth of 8.34% on the bear case for Microsoft, up to 19.5% on the bull case. Microsoft closed the day at $401.91. They have a PE ratio of 25.1, forward PE of 24.2. Microsoft has a PE ratio right now of 25, well below their 5 and 10-year average. The market very sour on Microsoft right now. They're quite cheap in my view. Based on that $401 share price, the market believes Microsoft will only grow their free cash flow by 10.8% over the next 10 years. A base case DCF, like I showed you, Microsoft growing their free cash flow at 14.2%. That gives us a DCF price for Microsoft at $333.14 for the bear case, $522.17 for the base case, and $784.80 for the bull case. Microsoft pays a very nice dividend, expected to be $3.60 this year. It also grows 10% annually like clockwork. A bear dividend discount is at $473.59, $586.29 on the base case, and $755.95 on the bull case. I have that growing at 9 to 11% for the three cases. The exit multiple sits at $487.43. And that is based on comps of Google, Apple, and Oracle. So you can see with all three cases right now, there is upside, but that's without a margin of safety. Without that margin of safety, it is at $542.28 buy price. With a 10% margin of safety for Microsoft, that is a $488.05 buy price and a forward PE of 29.4. So needless to say, I believe that Microsoft is in a very good discount. In fact, I think they're at the best discount of all three hyperscalers right now. The market is a little bit down on them because of the OpenAI situation, and they certainly don't view that RPO number very favorably. In 5 to 10 years, they're going to dwarf the size of the business they are right now. In fact, I bought more shares of Microsoft this week. It is my second largest holding, and I'd like to keep it that way for a very long time. Now looking at Amazon, and this is, in my view, a much broader, much more diversified business than Microsoft. Of course, their core is still their online retail business. They have online stores here. I have that growing for the next 10 years on the bear case at 5.5% up to 7.5% on the bull case. But Amazon has two segments of their business that are really pushing their growth forward that will be their driver into the next decade. That is advertising services and AWS. AWS, of course, is their cloud infrastructure business. And I have that growing at 12.3% on the bear case up to 15.56% in the bull case. Slightly slower than where I had Microsoft growing, meaning I believe Microsoft's going to take a share from AWS going forward. But it still will be a long time before Google or Microsoft catch up to AWS, just given how big their lead is right now. But their advertising services, think about all the sponsored products you see when you're shopping online, plus all those Prime Video ads that you see. Or that is a growth driver for Amazon as well. On the bear case, I have that growing at 12.24%, up to 15.3% on the bull case. So all in all, Amazon still has a lot of growth to go. And incredibly, Amazon, I'm projecting $802 billion for their next year's income. $802 billion. And in my opinion, Amazon will be the first business to ever reach $1 trillion in annual revenue. Now, Amazon operates at a much lower operating margin than the other two, primarily because e-commerce is still retail, which means it's still a very low margin business. And retail still makes up over 36% of the total business. And while AWS has a very nice margin at over 35%, the rest of Amazon, they don't report each of the segments individually. The rest of the Amazon has a margin of only 5.8%. So really operating in that retail environment really does pull the margins down quite a bit for Amazon. So that's why by year 10 on the bear, I have their operating margin at 14%, up to 19% on the bull case. That assumes, of course, massive growth out of the AWS segment. And free cash flow margin on the bear case, I have that at 11.1% for Amazon, up to 18% on the bull case by year 10. Their trailing 12 free cash flow margin right now is at 1.07%. In this fiscal year, 2026, they will have negative free cash flow. I'm projecting negative $38.7 billion in free cash flow. Amazon is not afraid to go free cash flow negative when they really believe they're investing in their next big thing. And of course, they're going all in on cloud infrastructure. But as investors, we're going to have to tolerate that negative free cash flow for at least just this year. But I do think it'll rebound over the next 10 years. I have the free cash flow growth rates at 37% on the bear case, up to 47% on the bull case. Again, that's so high just due to the fact our starting point for free cash flow is so low. Amazon sits at $209.53 right now at a PE ratio of 29.2. I have a forward PE for Amazon at 29.6. So just like Microsoft, Amazon is trading quite cheap in my view, 29.2, well below their 5-year average. Right now, at that $209 price, the market is projecting free cash flow growth over the next 10 years of 37.98%. My base case has that at 42.3%. Remember, that's because their free cash flow right now is so depressed, they're just starting from a much lower base. So that gives us a DCF bear price for Amazon at $184.25. My base case price is at $266.29, and my bull price is at $374.61. The exit multiple sits at $229.46. I'm using comps of Walmart, Netflix, Microsoft, Google, Salesforce, and Oracle. So without any margin of safety, I have a buy price of $257.67 for Amazon. Now I usually have a 20% margin of safety highlighted for Amazon. That would be a buy price of $206.14. But I find myself gravitating more towards about a 15% margin of safety for Amazon. So that means anything under $220 right now, I think, is a pretty fair price to buy into Amazon. I think they have an incredible growth trajectory ahead of them. And Amazon has also been a little depressed in the market due to their massive $200 billion projected CapEx. I honestly think that Wall Street is taking an overly traditional view of CapEx spending like this and really underestimating how beneficial it's going to be for these hyperscalers in the coming years. They literally are the landlords of compute. All AI training, all AI inference, all of it is going to go through these 3 hyperscalers. So just based on that, they're going to be capturing massive amounts of revenue. So to me, it's silly not to own one of these 3 hyperscalers. Really, you should own all 3. I actually bought more Amazon just yesterday. It's now my 4th largest holding. My cost basis, it's actually my 3rd largest holding, but I've had such an explosion in another holding of mine, Applied Materials, that it has surpassed Amazon in market value. So Amazon is still 4th, but once Amazon starts to take off again, it'll easily become my 3rd largest holding. Finally, we're looking at Google. If you had to twist my arm and ask me which of the 3 I thought was the best, I would say Google. I'm most bullish on Google, not just because of Google Cloud, but because of what they're doing currently in their search segment, as well as YouTube. If you've been watching a lot of my Google videos in the past, you know that I'm very big on the YouTube part of Google. YouTube is the most watched streaming service in the country right now, more than Netflix even. I've shown that data before in other videos. And Google has done something with search. They really figured out AI in search. All those little AI previews that you get when you do a Google search today have really boosted their search segment. And they're starting to accelerate there in terms of monetization. That is one advantage that Google has over the OpenAIs and Anthropics. They already had a ready-made platform for distribution, and now they're finally leveraging it. And they also have a ready-made platform for their AI agent, Gemini. All of the businesses that use GCP for their data repositories. So Google had distribution long before OpenAI and Anthropic were on the scene. They're finally learning how to leverage that distribution with AI. So Google very much will accelerate, and that's why I'm so bullish on Google going forward. So looking at Google search, over the next 10 years, I'm projecting 5.6% growth on the bear case, up to 10.2% for the bull case. For YouTube, I'm looking at 7.2% on the bear case, up to 10% on the bull case. And that means advertising total here, I have that growing at 5.35% on the bear case, up to 9.55% on the bull case. I'm trying to be very conservative here with my growth estimates in the advertising segment, as I want to see them execute over the next couple quarters with these AI overviews before I'm more confident in raising my growth rates here. These have pretty much been my growth rates the last few valuation summaries I've done for Google. The Google subs, platforms, and devices, that's fairly slow growing segment for them, 4.1% on the bear case, up to 8.1% on the bull case. And then we come to Google Cloud. The last 5 years, they've seen 35% annual growth in their Google Cloud segment. And in the last couple quarters, that growth has even accelerated. We saw them hit a quarter of 40% year-over-year growth. On the bear case, I'm projecting that to grow at 10.45% up to 18.97% on the bull case. So my total revenue then On the bear case, I have that growing at 6.11%. And for the bull case, I have that growing annually at 11.3%. Google currently operates at a margin of 32%. I project that operating margin will grow to 38% by year 10 on the bear case and 45% by year 10 for the bull case. Coming down to that free cash flow margin, like the other two hyperscalers, their free cash flow is a bit compressed due to the massive CapEx. I also believe that CapEx is going to pay off like for the other two. We're trailing 12 free cash flow margins at 18.2%. By year 10, I have that growing to 27.5% for the bear case, up to 40.1% for the bull case. That would give Google free cash flow growth over the next 10 years of 10.6% on the bear case, up to 20.4% for the bull case. Google is priced at $303.55. That gives them a PE ratio of 28.1. I have a forward PE for Google at 27.2. As you can see, they're actually a little bit higher than the historical average here, which means Google is just now getting priced more like Microsoft has historically been priced. Microsoft traditionally a software business, but the cloud acceleration is really going to be re-rating Google upwards. The market believes that based on that $303 price, they have a free cash flow growth over the next 10 years of 14.15%. Base case free cash flow growth is at 15.45%. I have a bear DCF price for Google at $211.67. My base case is at $314.34, and my bull price for Google sits at $465.95. Now, Google just started paying a dividend. They're only in their second year of paying this dividend, so I'm not really pricing it out here now. I want to get some more years of their dividend under their belt before I get a confident read on how much that dividend is going to grow. My exit multiple for Google is at $330.05. It is based on comps of Meta platforms, Microsoft, Netflix, Apple, and Amazon. So without any margin of safety, I have a buy price right now of $327.79. With a 10% margin of safety, which is my preferred margin of safety for Google, that's a buy price of $295.01 and a forward PE of 26.4. So of the three, I do think Google is, I would say, the most fairly priced or slightly overpriced at the moment. Google is also my largest holding right now by a wide margin as well. So even if it came down a little bit, I probably won't add more, but that's just because it's already such a large holding of mine. So right now I'm really trying to push more into Amazon and Microsoft and beefing up my share count there. But either way, I think all three of these hyperscalers are going to be the gold standard going forward in terms of compound growth. I keep saying it, but all AI compute, all AI inference, it goes through these three. They have to collect their toll. They're the landlords. All rent goes to them. They're going to be printing cash over the next decade. And I'm going to be there reaping the rewards as a shareholder. So let me reiterate one last time. Microsoft is probably the most undervalued at the moment. Amazon, slightly undervalued in my view. And Google, probably a little overvalued at the time being. But all three of them will be major growth stocks going forward for the next decade. And I plan on having them as a massive part of my own portfolio.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.